Good afternoon. During our last meeting, we conducted our interview regarding your business proposal for an equine therapy clinic. During that meeting, you answered a lot of questions that gave me a good idea of where your business is at and where you would like it to be. I'd like to tell you about some of the different business structures and then get into what may be the best fit for your business moving forward. Now, first of all, I'd like to address the structure of a partnership. I would like to do so because at the root of it, this is a joint venture between yourself and your best friend. You both have collaborated and intertwined your experience and your passion to create the model that you presented to me last time we spoke. I really appreciated that concept, and therefore I'd like to explain to you the advantages and disadvantages of entering into a partnership. Individuals will often want to join together an enterprise, either because they have varying skills or because they want to pool their financial resources. In these cases, they may trade as a partnership. A partnership is a relatively common and simple, inexpensive way to set up or structure a business. It involves two or more co-owners participating together to run the business while also sharing profits and understanding that the co-owners act on behalf of each other. In Queensland, partnerships are governed by the Partnerships Act. This legislation sets out the various rules, duties and requirements for partnerships. These include duties of trust, known as fiduciary duties, as well as a duty of care to the business and your partner, depending upon the type of partnership and the nature of the role in the partnership. Partners are obligated to keep their co-owners properly informed and to ensure all partners have a clear understanding of their rights, responsibilities, and obligations. So that for that reason, a written partnership agreement is very vital. The disadvantage to a partnership in this case is that the legislation also places joint liability on all partners for the business's debts and obligations incurred during their involvement in the partnership. Therefore, while one of the key benefits to a partnership structure is that the partners are entitled to share equally in the capital and profits pursuant to Section 27 of the relevant Act, the downfall to this is that a general partnership is not a legal entity, and therefore the individual partners are considered legal entities. What this means is that every partner is liable jointly for all debts and obligations incurred, and that at the end of the day, your assets cannot be protected. Therefore, there are various benefits to a partnership, and partnerships, they can combine resources and expertise of a number of people. It's easier, it's less expensive than companies to set up. Changing the legal structure is relatively simple, and partnerships are simpler to administer. However, as I said, the profits and losses, they are shared between partners according to the person's share as specified in the partnership agreement, which I believe is something that you expressed that you really wanted to avoid during this venture. So for that reason, I'd like to move on to non-profit associations. Now, as discussed earlier in the interview, you had mentioned that you and your friend had discussed and deliberated being a non-for-profit organisation. However, you were both very unsure of what that would entail and how it works. Therefore, I would go through the processes, legislations, and inner working of a non-for-profit so that you may decide that if this is an option that you would like to pursue. So you may want to operate your organisation for the benefit of a group or community as a charity or a non-for-profit. If so, there are legal structures that suit these types of organisations. Each structure has different legal obligations, liabilities, advantages and disadvantages. The duties for running a non-for-profit are to comply with the Associations and Corporations Act 1981. There are three key types of non-for-profits and associations. They are incorporated associations, cooperatives, and charities. So, steps to becoming an incorporated association, which I believe would be the best suited out of the three options for yourself, would include choosing a name, adopting a set of rules, electing a management committee, and lodging your application. When first establishing a non-for-profit, you will have to organise a common seal, which will legally identify your association and provides proof of your association on legal documents. So this will include all legal documents from your contracts of service to other providers or contracts for your clients. Next, you will have to open a bank account on behalf of the business with the name of the association. So this is a key aspect of a non-for-profit. The profits are not shared among directors or the committee, and to run such an association, all members must have a no-profit intention. This is something that will be really important for you and your friend to consider, especially if you wanted this to be a family-run business. You will both need to consider if your intention from the equine therapy clinic is to generate profit or not, and whether you can afford to do that if you choose not to. The last important feature of a non-for-profit is that it is a legally separate body, meaning that the committee can make business decisions and only the association will be liable for those decisions. Therefore, through the bad times or bad decisions, you can rest easy knowing that your family's personal assets will be protected. However, while your personal assets may be protected, it's still really important that you would have to insure your association, especially if it owns land, leases land, or holds land in trust. So public liability insurance will help to protect your association's assets in the case of an accident in which the lawsuit may arise. We did discuss risk. You did express to me that you did feel as though there could be some risk, especially having people and animals. So that's a really good idea if you choose that option. So all of these decisions, they can be agreed upon by the management committee, who will have the responsibility to assess the nature and situation of the association and decide what it needs, how much it needs, and go from there. Now, the last structure that I would like to discuss and present to you is the structure of a company. So in Australia, the three most common types of companies are proprietary limited companies, where they cannot raise money from the general public through share issues, or public companies, usually formed to raise or borrow public money by listing the company's shares for trading on a stock exchange. The type of structure that I'll be discussing with you is proprietary limited company. In setting up new ventures to commercialize an idea, 1, 2, or more people can set up a proprietary limited company. A proprietary limited company is an entity separate from its shareholders. So in English, the assets and liabilities of the company are separate from that of the people who own the company. In good times, this means an influx of dividends paid to the shareholders as prescribed by the constitution of the company. In bad times, this means that the shareholders won't have homes and other assets seized to pay debts incurred by the company. Generally, shareholders can only lose the value of their shares and are not liable for the company's debts. This is called limited liability. This is significantly different from the other business structures, such as a sole trader or a partnership, where the parties to the partnership or sole trader can be held personally liable for the obligations of the business. And as I understand, this was of central importance to both yourself and your friend. Further to this, legal arrangements are in the company's name, not in your name or the directors and managers. The business structure ensures continuity of management and ownership in the event of a death or disability of key people, because company shares can be transferred. Additionally, the tax rate for companies is less than the highest rate for individuals. So for these reasons, it is easy to understand that business owners do really like to favour this structure, and that the separation it provides is great just when having a security in doing business. So while the company structure has many benefits, it's also important to discuss that in turn, companies are managed by stricter legislative requirements based on a number of differing factors. Companies are more regulated than other business structures, and as such, the rules for establishing and running a company are more complex and costlier than other business structures. Further, if directors fail to meet their legal obligations, they may be held personally liable for the company's debts. So if you and your friend did decide that the benefits of the company outweigh the benefits of the other structures, it is very important that both you and your friend recognise that you must strictly adhere to the relevant legislation and legal obligations provided to you through the Corporations Act. So in conclusion, while all structures pose advantages and disadvantages, it would be my personal recommendation that you choose either the non-for-profit or the company. My reasoning for this is that they both possess the essential requirement for you and your family, which is limited liability, wherein yours and your family's assets are protected at the end of the day. From there, it will be for you and your friend to really decide on whether you wish to pursue the business venture with the intent to make profit or not. Whatever your decision may be, you can then choose your business structure from there.